Okay, so hello, good day to everyone. So we are going to discuss today the derivatives and risk management. Okay, so I know you're already familiar with some of the derivatives. Okay, so because some of them are already discussed in your financial accounting, while um, the risk management. So I understand you have already undergone the subject risk management, but today we're only focusing on the financial risk management. So kana lang ang focus sa atong discussion today. So just to recap what we have already discussed, so we are done with the capital structure and leverage. So we in that topic we were able to um, identify the right mix of our financing. Okay, so whether it's from liabilities or equities, so there should be a right mix so that we can minimize the cost of capital. And then we also discussed the distributions to shareholders, particularly dividends and stock repurchases. So when would be the ideal situation to issue dividends, and when is the ideal time to issue stock repurchases? Okay, so under this topic, derivatives and risk management, we have the following. So first, we have what are the motivations for risk management? What are options? How to value the derivatives, and why is it important that we know how to value derivatives? And we will also discuss the other types of derivatives. And lastly, the fundamentals of risk management. So why might stockholders be indifferent to whether a firm reduces the volatility of its cash flows? So when say indifferent, so regardless of the alternatives, they are the same. So they are the same cost and they have the same benefits. So either of the alternative, so there is no opportunity cost for the stockholder. Diversified shareholders may already be hedged against various types of risk. So in investing, especially in stocks, so one recommendation is to diversify the stocks. Okay, so you have to buy different shares, different types of industries or sectors, so that the risk can be offset. Okay, so pwede siya ma-offset with the gains of other company. So for example, if you have invested in mga real estate properties or mga business that has something to do with recreation. Okay, so as we know already, so this pandemic brought negative impact to those businesses. However, there are sectors or businesses that still thrive even during the pandemic. Okay, so examples of these companies are mga utility companies such as water, mga electric companies, and we also have mga pharmaceutical companies and grocery stores. Okay, so regardless of the economic situation, we still need to buy those things. So if you hold those types of stocks in your portfolio, then you may be able to diversify or hedge against some risk. Okay? Reducing volatility increases firm value only if it leads to higher expected cash flows and or a reduced WACC, or the weighted average cost of capital. Yes, while the investors would like to have higher returns, but as we know, the investors are very risk averse, so they don't want to take risk. So if the risk cannot be avoided, then they will find ways how to mitigate those risks. Okay, so we say volatility, so it's the uncertainty. Okay, the rise and the fall of the prices in the market. So the volatility will only be mitigated or decreased if there is certainty as to the expected cash flows or reduced reduced cost of capital. So here are the following reasons why the corporations engage in risk management. So first, it is to reduce the volatility. Okay. So the reduced volatility reduces the bankruptcy risk, so which enables the firm to increase its debt capacity. So of course, if the volatility is reduced, so there's certainty of cash flows, then the firm can increase its debt capacity or its ability to borrow more money for the firm. Second reason is by reducing the need for external equity, so the need for external financing, so such as loans and issuance of stocks, firms can maintain their optimal capital budget. So as we have discussed previously, so ang pinakabarato gyud niya financing is the financing that comes from within or comes from the retained earnings. So you don't need to pay interest, you do not need to pay issuance cost. Third reason is reduced volatility helps avoid financial distress cost. So of course, if there's certainty of earnings or cash flows, then it reduces the financial distress. Okay. Another reason is that managers have a comparative advantage in hedging certain types of risk. So if the manager know how to manage the risk, okay, so it can become an advantage over other competitors. Okay, so if ang manager is very uh, proactive, so those managers are more likely to succeed compared with managers that are very reactive to mga certain situations. Next, reduced volatility reduces the cost of borrowing. So if there's certainty of cash flows, then it reduces the cost of borrowing. Another is reduced volatility reduces the higher taxes that result from fluctuating earnings. So, so there are times, kung may say volatility, there are times nga medyo taas atong income, there are also times na medyo ubos kayo. But if there is a dili kayo, kumbaga very stable returns, so we can already predict the taxes that we are going to pay to the government. Then lastly, you have certain compensation schemes reward managers for achieving stable earnings. So there are performance measurement tools that the firm uses to evaluate the performance of their managers. So, and one of them is to achieve a stable earnings for the business. So, stable earnings can be achieved if we are able to manage the uncertainties in the market. Okay? So, particularly sa mga financial transactions. Okay, so now let's proceed to the options. So, what is an option? So, an option is a contract, okay, that gives its holder the right. Okay, so take note, it's only the right but not the obligation. So you cannot force the holder to buy or sell an asset at some predetermined price within a specified period of time. So that the option contracts only gives you the right whether to buy or sell a specific asset. So there is already a predetermined price. So nanay price nga nakaset. Okay? And then there is a specified period of time which you can only exercise your right. So for example, you are given the option to buy Jollibee shares after 6 months for let's say 250 pesos per share. Okay, so you're only given 6 months to decide whether to buy or sell, or I mean to buy the Jollibee shares at that specific period of time. Now, when the time comes nga nga matured na, or let's say niabot na og 6 months, okay, and then still you did not decide to buy, so wala na siya problema. Okay, because what you are buying in this contract, okay, is not really the shares or the stocks, but it is your right nga kana nga offer ihatag na sa imo at the right time and at a specific price. Okay, so it's important to remember that the option contract does not obligate the owner to take action. So whether the holder will buy or not after 6 months or within 6 months, um, wala na siya problema, because the contract here is the kumbaga ang prestation or the object of the contract is not the asset or the stocks, but it is the right. Okay, the right to buy at a specific price and at a specific period of time. Second thing to remember is that it merely gives the owner the right, okay, to buy or sell an asset. So you're only buying the right and not the asset. So in options, we have to be familiar with the different terminology. Okay. So the first type of option is called the call option. So we say call, so you are going to buy. Okay. So it is an option to buy a specified number of shares of a security within some future period. So it is the right to buy at the specific with the specified number of shares at a specific period of time, or especially future period. So always remember, call equates to buy. Okay, and put option. So you are putting. This option is the option to sell a specified number of shares of a security within some future time. So kung ang call is the right to buy in the future, the put option is the right to sell. Okay? The right to sell a specified number of shares in the future. Then you have exercise or strike price. Okay, so you have the exercise or the strike price. It is the price stated in the option contract at which the security can be bought or sold. So the exercise price, so that's the price nga giset sa option contract nga pwede nimo siya nga mapalit ang shares, for example. So katong Jollibee shares nga 250 per share, the 250 is the strike price or the exercise price. The strike price may be the same or may be different from the corresponding market price or the prevailing price at that time. Option price, so it is the price of the option or the option contract's market price. So how much can you sell how much can you sell or buy the option contract? Okay? Because kating sa option contract, you need to buy or you need to pay uh, if you are if you buy the option price or option contract, then you have to pay something for that right. Okay? In exchange for that right nga na kay option to buy or not. So another terminology is the expiration date. So the option contract has an expiration date. So that is only the period of time which you can exercise the right. After that, the right ceases to exist. Okay, so dili na nimo siya ma-exercise. Exercise value. So the exercise value is the difference between the stock price or the prevailing market price for that stock minus the strike price. So for example, if si Jollibee after 6 months na mo na siyang 350, but since you have the option contract which you can buy only at 250 pesos. So the difference between the market price nga 350 minus the strike price nga 250, that is the exercise value. So 350 minus 250 is 100. Then covered option. So it is an option written against the stock held in an investor's portfolio. So kung nagpalit kag covered option, so there is a collateral nga mga stocks. Okay? So so the stocks are held in the investor's portfolio. While the naked or the uncovered option, this is an option contract written without the stock to back it up. So walay naka-collateral nga stocks. And then we have the in the money call. So it is a call option whose exercise price is less than the current stock price of the underlying stock. So you will only, of course, logically, you will only exercise the option contract if the exercise price, okay, or the market price is higher, ano, yeah, is higher compared to the strike price or the exercise price, 'di ba? So, for example, call option. So, buy Jollibee shares. So, ang market karon 250. Okay? But in the strike price, in the option contract, you can buy it only at 250. So, as long as the market price is higher than the the exercise price, so you will exercise, most likely you will exercise your right to buy. Okay? And that's why it's called in the money. Okay? However, if the market price is lower, okay, let's say 200 ra ang nasa market, okay, but in your option contract, exercise price is 250. Since you can buy a cheaper price in the market kaysa i-exercise nimo imong right, okay, di ba? Mas barato ra gud ang naa sa market karon kaysa sa imong exercise price. So most likely you will not exercise your option. Okay? You will not exercise your option, but rather you will choose to buy in the market, okay, with other investors. So since you do not exercise the right, okay, so it is called the out of the money call option. Okay? Out of the money. So ang in the money, the market price is higher than the exercise price. While in the out of the money, the market price is lower compared sa exercise price. Then another term is the long-term equity anticipation securities, or also known as LEAPs. So it is similar to normal options, but they are longer-term options with maturities of up to 2.5 years. So most option contracts man gud, di mo gud na sila maabot og isa ka tuig. So usually mga by months, okay? So dugay na kaya ng isa ka tuig, okay? However, in the US, they have invented an option nga mo last up to, or the maturities will last up to 2.5 years. So they call it the LEAPS, or the long-term equity anticipation securities. So let's have an example. So the call option has an exercise price of $25. Then the stock prices. So the other is the left side. So you have 25, 30, 35, 40, 45, 50. So kanus agay na to i-exercise ang option. So we will only exercise the option if the stock price is more than at least or minimum or at least $25, 'di ba? So if the market price keeps on increasing, the more likely we will exercise the option. Whereas if the stock price is below 25, so it's out of the money, so we will not the value of the option is useless. Okay? So we will not exercise the option if the stock price or the market price is lower than the exercise price. So as you notice, the call option price, so the value of the option or the price of the option increases relatively to the increase of the stock prices. So of course, mas valuable if the stock price uh, or the difference between the market price and the exercise price is uh, dako og difference. Okay, so the more difference, so the higher the call option price. So if the stock price is 25, the call option price is $3. So pag abot og 30, na mo siyang 750. If the stock price is 35, the call option price is 12, so on. So how to determine the option exercise value and the option premium? So exercise value is actually the difference between the stock price and the strike price. Okay. So if the stock price is higher compared sa stock price, so the exercise value is zero. Okay, so walay kuan. You do not exercise the option. If the stock price is the same with the strike price, then the exercise value is also zero. So there's no difference. However, if the stock price is 30, so constant pa ni mga strike price na to nga 25. So the difference is the exercise value is now 5. And when the stock price is 35, the exercise value is 10. So yun sa pagkuha ang exercise value, you simply deduct the stock price sa strike price. So the higher the price of the stock price, the higher the exercise value. So we have already seen the option price a while ago, di ba? So katong if the stock price is 25, the option price is 3. If the stock price is 30, you have 7.50, so on. So we can now compute the option premium or the difference between the exercise value and the difference between the option price and the exercise value. So $3 minus the exercise value, you have 3. And then option price 750 minus 5, you have 2.50. So 12 minus 10 is 12. I mean 2. 1650 minus 15, you have 150. So just a kuan lang remark on the option premium. Okay, so if you notice as the stock price gets higher, okay, the option premium or the difference between the exercise value and the option price decreases. Okay, so the option premium decreases as the stock price increases. So how does the option premium change as the stock price increases? So the premium of the option price over the exercise value declines. So as you notice, nagka-decline ang iyang option premium if the stock prices increases. So this is due to the declining degree of leverage provided by options as the underlying stock price increases. So the greater loss potential of options at higher option prices. So we have the call premium diagram. So we have the market price kaning gray, and then you have the exercise value or the strike price um, kaning color nga violet. So since so the call premium, okay, so it's actually the difference between the market price and the exercise value. So kaning nasa tunga. So if you notice, magkataas ang stock price, magka nipis or magka gamay ang difference between the market price and the exercise value. So that's the reason nga mag-decline po ang option premium sa ilang difference. Now, one model or one formula uh, to use in the valuation of the options is called the Black-Scholes option pricing model. Okay, so the reason why we need to value the we need to know how to value the option so that uh, makahibalo taon say presyo nga atong or what is the fair price nga dapat nato i-set whether to buy or to sell the options. So if we do not know the value of that thing, so mas maglisod taog set sa price. However, if we know how to value then we know kung ang isa ka option would be a cheap or expensive ra. Okay? So the stock underlying the call option pays no dividends during the call option's life. So kato daw stocks nga gigamit to as a collateral for the call option, this these are the following assumptions when we use the Black-Scholes option pricing model. So first assumption is that the stock underlying the call option pays no dividends during the call option's life. There are no transactions or costs for the sale or purchase of either the stock or option. So we have to set these assumptions, otherwise it will not it will dilute the relevance of the option pricing model. Third assumption is there is an unlimited borrowing and lending at the short term risk-free rate, so which is also known and constant. There's no penalty for short selling and sellers receive immediately full cash proceeds at today's price. Option can only be exercised on the expiration date, and security trading takes place in a continuous time, and stock prices move randomly in continuous time. So these are the assumptions so that we can use the Black-Scholes option pricing model. So this is the formula. So so in the Philippines we don't have the market for options. However, so we still need to be familiar with the valuation of the options because um, a lot of the countries are naagid sila established nga market for the options. So so just to be familiar with how they value the options, so this is the formula that they use. So D1 they used to get the D1 and D2. Okay, so to value the options, so ang atong i-focus is kaning kuan, kaning nasa kaning V. Okay? So the formula in getting the value of the option is P, which is the price, the market price, and multiplied by ND1 minus the exercise price raised to negative nga risk-free rate multiplied by time, and then multiply it by ND2. So in some problems they are already given. Okay, so especially in the board exam, so since we cannot use already the scientific calculator, so I don't think they will give you inani ka complex nga mga calculations. So most likely they will only give you the the amounts. Okay, so so to get the D1, so mo ni siya, so 0.736, and then for D2 is 0.3391. So to get the ND1, so it's already given. So it's 0.7168, and D2 is 0.6327. So to get the value of the option, so you have the price, the market price, which is now at 27, and then katong multiply nato sa katong ND1 gaina nga gihatag, that's 0.7168 minus the exercise price nga 25, uh, raised to the risk-free rate nga 6%, then multiplied by the time, which is 6 months, so that's half of the year, so that's zero point 0.5, multiplied by ND2, which is 0.6327. Therefore, the value of the option is at 4.00 or $4.4 or 4.0036. So, mo ni imong basis whether if there's a market nga mo parehas ani. So if the value of the option sa market is below ani, then it is said that the option is undervalued. If the price in the market is higher than $4, then it is said that the option is overvalued. Okay, so that's the Black-Scholes option pricing model. So the other way of valuing the option is called the binomial option pricing model. So mas simple ni siya compared kay Black-Scholes. So this is known as the binomial option pricing model. Okay. It's called binomial. It's because you are only using two variables. Okay, so or binomial OPM. So you have the data. So the market price is $15. The exercise price is also 15. Then the time is 6 months or zero point 0.5. Then the risk-free rate is 6%. So gikuha ni nila sa treasury. So the ending stock price, so let's say the range is from 10 to 20. Okay. So you're expecting that the range of the stock price would only be from $10 to 20. So you choose the both extreme, 10 and 20. So therefore the difference between the two or the range is $10. Strike price is the same regardless of the stock prices. So you have 15. So all option value. So it's the difference between the strike price and the market price or the stock price. So again, if the stock price is higher than the stock price, the value of that option would be zero because you will not exercise the call option. Okay? So that if the stock price is also 15, the call option value would also be zero. If the ending stock price is 20, so there is already a call option value of 5, or the difference between the ending stock price and the stock strike price. So the range of the call option value would be from 0 to 5. So the range is $5. So first step in using the binomial option pricing model is to create a riskless, okay, or riskless nga situation. So dapat daw kuno regardless of the alternative, walay difference. So what do you mean nga why difference? Dapat daw the range of the stock price and the call option value would be the same. So kung 5, dapat ang relevant the range of the stock price would also be 5. If 10, then the call option value would be 10. So how uh, to create a riskless nga hedge? So dapat magparehas ang range ni stock value ug ni option value. So regardless kung 10 or 20 imong stock price, so giyon sa pagkuha ang 50%. So actually you can get the 50% by dividing 5 sa range ni stock price. So 5 over 10 is 50%. So if you multiply 0.5 sa katong mga stock prices, so you will get $5 and then $10. So option value. So of course, if the stock is a 5, the exercise price is okay. So the stock price is a 5. So the option value is 0. So the value of the portfolio is $5. And then you have ending stock value nga 10. So and then the ending option value nga negative 5. So the value of the portfolio is $5. So regardless kung 10 or 20, so they are the same. So the investors is indifferent to either of the alternative. Okay, so actually I think there's some mistake here. Okay, so as I mentioned gaina, so we can create a riskless hedge if the value of the range of the ending stock value is the same with the value of the portfolio. So remember that the strike price is 15, 'di ba? So if the strike price is 15 and then it is higher compared to stock price, then the option value is 0. Since both 5 and 10 is lower than the strike price, then the option value of both contracts is also 0. So if you notice the range of ending stock value, okay, so this is the range. This is 10. So therefore, the range also for the portfolio is also 15. So we are now creating a riskless nga hedge. So how to get the first thing to determine to after creating a riskless hedge, uh, the next thing to do is to find the present value of the riskless nga portfolio. So we have $5. So how to get the 1.0296? So you have 1 plus the risk-free rate, I think is 6%. I'm not sure. Yes, 6%. Multiplied it by time. So it's only 6 months. So the raised to zero point 0.5. So the present value of the riskless for portfolio is 4.86. Okay, so let's go for third step. Calculate the cost of stock in the portfolio. So what is the cost of stock? So that is the percentage of stock in the portfolio times the stock price. Okay. So if you recall, the stock price is at $15. So mo na to i-multiply sa 50%. So you have 7.50. Now, kung nakuha na nato ang 2 ug 3, we can now calculate the market value of the option or the value of the option. So the market value of the option is simply the difference between the cost of stock, okay, the cost of stock and the present value of the portfolio. So we know that the cost of stock is 750 while the PV of portfolio, so katong gi-compute gain na, that's 4.86. So the value of the option is at 2.64 or the price of the option is $2.64. Okay, so how do the factors of the Black-Scholes option pricing model affect a call options value? So these are some of the factors. So unsay impact nila sa option value. So if the current stock price will increase, so if the current stock price will increase, the value of your option also increases. And if the exercise price increases, the option value decreases. Time to expire, so the longer the time period nga mo expire siya, the value of the option also increases. Kaya 'di ba mas volatile man kung if the stocks are held in a longer maturity. So mas dako og chance nga magsaka ka na og ang price compared sa sa stocks nga let's say only good for 3 months or what less than 1 year. So dili kayo ina nakadako ang changes. So if the time to expiration all increases, therefore the value of your option also increases. So most likely dagay gusto mo palit og option just to hedge against the risk of the longer maturity or longer expiry. If the risk-free rate increases, the option value of the value of the option also increases. And if the stock return is very volatile or taas ang volatility sa stocks, so dako og chance nga magsige ka saka kanaog ang stock price, then the option value will also increase its value. So mora na inyong timan-an nga basta negative and then it will increase volatility. Okay? Kung dako mas grabe ang uncertainty, the value of the hedge nga option will also increase. Balik na ni siya. So what are the other derivative contracts? So first we have the forward contract. So it's a one party agrees to buy a commodity at a specific price on a future date and the counterparty agrees to make the sale. In the forward contract, there is also a physical delivery of the said commodity. So usually, mga forward contracts, gina-execute ni sila especially if the price of the raw materials is grabe ka volatile or very uncertain ang iyang price. Sige sa kakanaog. So for example, sa mga airlines, so they need, of course, they need oil para magpadagan sa ilang eroplano. And dili na siya, dako kayo na siya nga consumption. Okay? So, one way to hedge against the risk of the rise and fall of the prices of the oil is to come up with a or to execute a forward contract. So the forward contract, ang nakabutang dito sa kontrata is fixed ang price. So there's a specific price nga imong bayaran on a future date. So let's say after 1 month, after 1 year. So the price nga giset sa katong forward contract, mora sad to ang price nga imong gamiton to purchase to purchase the oil. Okay? So regardless kung unsay nahitabo sa market, whether mas dako pa sa specific price or mas gamay pa sa specific price, you have no choice because you have already executed a forward contract. So you have to buy it at that specific price only. So let's say ang gi-specify nimo is 1,500 per let's say liter. So you have to honor the forward contract. Maski pa og ang nasa market is naa sa 1,000 or 900, since you already executed a forward contract. So muna siya. The advantage, however, is kung grabe ang pagsaka sa price sa oil. Let's say na mo siyang 2,000 or 3,000. Having a forward contract will reduce or mitigate the loss. Okay? So since naka-specify naman nga 1.5 ra gyud imong paliton per liter, then mora pud na ang price kay imong ibayad and not the market price. Another derivative contract is called the futures contract. So in a futures contract, it is standardized exchange traded contracts in which physical delivery of the underlying asset does not actually occur. So it's actually kuan lang, speculation. Okay? So you're betting against the prices of, for example, mga commodities such as rice, corn, copper, nickel, so on. and even mga prices sa oil. So ang inyong kontrata lang is mura mo og nagbet kung musaka ba or naog ang price ani nga mga commodities, and whatever is the difference mo na bayaran sa other contracting party. So you can have futures contract of the commodity or financial bonds. So these are, however, you do not buy the bonds and stocks or any financial market. Ang inyo lang gisabutan diri is, um, if ever nga mosaka ang price sa stocks, then you have to pay me the difference. So marag inana siya. So I will bet nga mosaka siya at this price. Ang isa pod niingon niya, dili na siya mosaka, monaog na siya ani. So kinsa to'y sakto, mo to siya bayaran. So somehow it's like a kuan gyapon, mo siya og na pagka-gambling. Okay? So that's why it's called, the futures contract is an speculative contract. So nag-speculate ra ka, nag-observe ra ka sa prices aning mga commodity and financial futures without the intention of being delivered physically in the future. So you do not, there's no intention to buy those commodities and futures. You are only contracting for the sake of the change in the prices of these commodities and financial futures. Another derivative is called the swap. Okay, so it's the exchange of cash payment obligations between two parties, usually because each party prefers the terms of the other debt's contract. So, for example, one is fixed, na fixed payment, and then ang isa is floating. So, let's say depende sa interest ng isa, ang isa is naka-fixed. So, pwede mo mag-swap o debt contract. So, let's say ang isa ka party is fixed ang iyang dawatonon, pero gusto siya katong floating. So, si B pod na ina nga contract nga magdepende siya sa, let's say, interest rate. So, if si B ganahan og fixed, si A ganahan og floating, they can swap their contracts. Okay? And then, katong ilang mga customers, the payment, although pwede dawato ni A, pero padulong na kay B. And ang katong customer ni B, nakakontrata sa iya for the floating, ang payment ato padulong na kay A. So, the swaps or pwede floating to fixed or fixed to floating. So when we say fixed, there's a fixed nga amount or interest rate, while the floating is nakadepende siya sa market kung pila interest rate. So swaps can reduce each party's financial risk. So hedging the risk. So hedging is usually used when the a price range could negatively affect a firm's profits. So we only use hedge if um, the price of a certain material or the price of something can affect the firm profit. So let's say katong sa airline industry. So of course kung grabe ang pagsaka sa presyo sa gasolina, so apektado kayo ilang profits. Okay? Because they consume a lot of gasoline. So ang katong raw material kato ilang cost of goods sold will most likely increase. So it can affect their profit. So one way of hedging this risk or mitigating this risk is to come up with a forward contract. Okay? So para ma-fix na ang price, and then we can already uh, kumbaga if there's a certainty, masayon siya mag-budget. Okay? Long hedge. So it involves the purchase of futures contract to guard against a price increase. So katong mga forward contract, so if you enter into a long hedge, so your purpose there is to guard against a price increase. So let's say ang kontrata is nasa 1,000. So you choose this hedge because in the future probably mahit mo na siyang 1,500 or more than that. Okay? So without uncertain mo gud ang future, especially sa presyo sa mga oil. Short hedge, it involves ang kaina is ang mag-purchase ka of future to guard against price increase. In a short hedge, someone are selling this futures contract to protect against a price decline. So especially sa mga put option. So unsaon man na nila pagkita kung inana. Okay? So for example, they're expecting mo fall pa. So if the current scenario is 1,000, then you are expecting in the coming years may mo siyang 500 or lower than 500. One way of mitigating the loss or the price decline is to sell now, okay? To sell contracts today or sell the futures contract today at a fixed price para in case nga in the future mo down siya, okay? Mo down siya, you are already assured nga ang presyo ra gyapon is naa sa 1,000. Okay? So usually ang maghimo og short hedge katong mga supplier, okay? Or magbaligya sa put option. So they don't want nga malugi. So that is why ila nang gi-fixed ang mas mobaba pa ang presyo. Whereas kung ikaw ang buyer sa raw material, most likely you will buy the long hedge because you don't want to pay a higher price for your raw materials or goods. Because higher raw material prices will mean higher cost of goods sold and lower profits. While if you're a supplier or a seller, you don't want to sell your things or your products for a lower price. So you are now entering into a futures contract to protect against the price decline. So long hedge, protection against price increase. Short hedge, protection against the price decline. How can commodity futures market be used to reduce the input price risk? So when we say input price risk, this refers to the possible increase of the raw materials. Okay, so price sa mga raw materials mo increase. So how to use the commodity futures market to reduce the input price risk? Okay, so the purchase of a commodity futures contract will allow the firm to make a future purchase. Okay, so katong sa short hedge, if you can remember, so future purchase, long hedge. So future purchase, but the price is set at today's price. So even if in the future the market will increase, the market price will increase, so dili na siya makaapekto sa imo because you have already entered into a contract nga nakalock in na nga you will buy this raw material at a fixed price in the future. Then we have the last topic. So it's about the corporate risk management. So why is it important to all firms? So corporate risk management relates to the management of unpredictable events that would have adverse consequences for the firm. So those unpredictable events usually mo magud to siya mukos og dako nga impact sa business. So for example, the pandemic. So no one is anticipating nga mahitabo ni siya. So um, those unpredictable events have a very big or adverse consequences for the firm. So as we have noticed or observed, so some firms are already uh, facing bankruptcy. Some firms or businesses have already closed down because of the pandemic. So because of the current situation or current events, so there's a need to come up with the risk management plan. Okay, so the risk management is now more relevant than ever. So all firms face risk, but the lower those risks can be made, the more valuable the firm. So if you can already have a plan on how to mitigate or avoid possibly those risks, or perhaps you can transfer those risks, then the firm becomes more valuable because you have reduced the volatility or the uncertainty in your business. However, in doing so, you're also incurring a cost. So naginay cost, there are some risks or risk mitigating tool nga na ay cost. Like for example, kung magpa-insure ka sa fire, okay? So in case nga na magka-fire imong building or imong business, somebody will pay for the amount para matukod og balik ang building. So to be able to reduce the risk, you need also to pay. Okay? Although the amount is really not that high, dili na naka-significant compared sa amount nga pwede nila ihatag sa firm. Or perhaps magpalit ka og mga CCTV to reduce the theft. So nagyapoy cost ang pag reduce sa risk or ang pag-manage sa risk. So we have different types of risk. So we have the speculative risk or offer the chance of a gain as well as a loss. So there are investors who are after the kuan, let's say sa stocks, or they are betting or speculating as to the increase or decrease of the share prices. So if of course if they buy it at a lower price and then suddenly nag-increase siya, then they will have gain. Kung mas ubos pa sa ilang gi-purchase, then na loss. So we call that speculative risk. Then you have the pure risk. So offers only the prospect of a loss. So kanigid siya uh, uh, mo gani tinuod nga loss when the business incurs a loss tapos na bankrupt siya. So of course, ang investor pod will incur a loss. So that's called pure risk. Then you have the demand risk. So it's associated with the demand for the products or services. So if there is a high demand, so the demand risk is low. So if there is a possible demand nga moubos, then the demand risk is high. Input risk is associated with the firm's input cost. So katong giingon nako nga kung mutaas ang presyo sa gasolina or posible nga mutaas siya in the future, so mas dako ang imong input risk, especially if you are using those to buy or to manufacture products and services. Then you have the financial risks. So these are the risks resulting from financial transactions. So for example, kana magpautang ka, tapos di mabayaran, so that's an example of financial risk. So or for example, nag-invest ka, so whatever is the result, kung negative, that's a financial risk. So again, you have speculative, pure. So ang speculative is whether to have a gain or loss. Pure risk is the loss of the business. Demand is the demand for the product. Input is the price increase or of the raw materials. Financial risk is from the risk or loss from rising from financial transactions. We have the property risk. So these are the risks associated with the loss of a firm's productive assets. So for example, nasunugan inyong pabrika or inyong business. So we call that property risk. We also have personal risk or personal risk. So it results from the human action. So example, ani katong mga fraud and embezzlement. Environmental risk is the risk associated with polluting the environment. So if your business can somehow contribute to pollution, so you are having an environmental risk. Liability risk, so connected with the product, service, or employee liability. Then insurable risks. So these are the risks that can be transferred to the insurance company. So mga fire, um, theft perhaps. Okay, so pwede na siya ipa-insure. Then what are the three steps of corporate risk management? So what are the three usual steps in conducting the risk management? So first is to identify the risk faced by the firm. So identify the risk. Second is to measure the potential impact of the identified risk. So in your ERM or the risk management, so usually, di ba, we not only the impact of those risks, but we also measure the likelihood. And then third step is to decide how each relevant risk should be handled. So how to handle those risks? Pwede ba nato to siya ma-avoid? Or pwede ba siya ma-mitigate? Or ma-lessen? Or perhaps na risk nga pwede nato i-transfer to other companies? Or we have no choice but to accept those risks. Okay? So those are the possible actions or possible four main actions that we can do about the risk. Okay, so just to recap what we have discussed. So we have discussed the motivations for risk management, the options, the nature of the option contracts, and how to value that using the Black-Scholes option pricing model, and then the binomial option pricing model. We also discussed the other derivatives, such as the forward contracts. So forward contracts needs physical delivery, while the futures contract is speculative. Okay. So we also discussed the swaps. Okay. And then the different types of risk. And lastly are the three steps or the three major steps to uh, for the corporate risk management. Okay, so so we're done now. Now, if you have some questions or clarifications, so please feel free to message me through my messenger or perhaps through email. Okay, so you can use your or use nga email to message me to ask if you want to ask questions. Okay, so that's all for today. So thank you for watching this recorded video. So again, feel free to clarify things or ask questions through any medium. So you can use the messenger or email for questions and clarifications. Okay, so thank you and have a nice day.